When it comes to investing, the golden rule was a 60-40 allocation, 60% towards stocks and 40% towards bonds. But now this is being considered a bad move. So I want to tell you what the experts and the financial advisors are now saying, and then I want to give you my opinion. Let's start here. First, what is the 60-40 rule in investing? And to help answer that question, let's Google it. Let's ask Google AI. It says the 60-40 rule is a traditional investment strategy that allocates 60% of a portfolio to stocks for growth and 40% towards bonds for stability and income. Maybe you're doing this in your retirement account, mutual funds, 529 plans, or a combination between your retirement accounts and a brokerage accounts. Okay? But why is this allocation considered the golden rule? It's because this strategy was designed to balance risk and reward. The stocks are supposed to give you high growth, and the bonds are supposed to give you stability, income, and they're supposed to act as a buffer against stock market volatility. Essentially, it's like a combination of balancing good offense and good defense. I did a Google search for the full year of 2023 to see what the news articles are saying about this whole 60-40 allocation back then, and I want to show you the results. This is what pops up. The 60-40 investing principle still holds. Why this classic investment strategy still works. Don't let the bonds sell off dismantle your 60-40 allocation just yet. Essentially, all good things about the 60-40 rule. But now, in 2025, more and more people have been disagreeing with the 60-40 allocation. For example, the CEO of BlackRock, Larry Fink, has been challenging the 60-40 rule. Okay, even though most people hate his guts, it's still good to know what these people are saying. In his letter, he's recommending people go from 60% stocks and 40% bonds to 50% stocks, 30% bonds, and 20% private assets, such as real estate. First of all, I don't agree with this, but the reason why he's warning against the 60-40 rule is because he says that this allocation may no longer fully represent true diversification. So why is he saying this? It's because when stocks go down, investors should run towards bonds and bonds should go up. But recently, it hasn't been working out like that. For example, when Liberation Day occurred, stocks went down and bonds went down also. So they both went down. The whole point of the 60-40 rule is to give you diversification. If one thing goes down, then you should have something else to offset or balance it. Another thing should go up, or it should at least, maintain or stay stable. But now, what have we been seeing? If bonds go down in price, then the interest rate goes up, right? There's an inverse relationship. And when interest rates go up, then the stock market goes down. So when bonds go down, stocks go down too. So have these past few instances been anomalies when they both go down together? Or is this a new trend? Well, the fear is the Sell America trend will continue and even accelerate. Okay, so what's the Sell America trend? It's when other countries dump our US treasuries and they pull money out of the US stock markets. Okay, so if foreigners purchase fewer of our bonds or they dump them, then where are they going to invest their US dollars? Well, clearly that's not a mystery. They're buying gold. Foreign central banks now hold more gold than US treasuries. So this is the first time that's happened since 1996. Okay, so I showed you BlackRock, but now take a look at what these other financial advisors and experts are recommending. And we're going to start with this one. Now they're saying that instead of 60% stocks and 40% bonds, that they favor 60% stocks, 20% bonds, and 20% gold. So this is coming from Morgan Stanley's chief investment officer, their CIO. Their CIO says that people should add gold because gold acts as an inflation hedge, and that in this type of inflationary environment, investors want to be compensated higher interest rates if they're going to be investing in bonds, which means that bond prices need to fall. But just to be clear, we're not talking about treasury bills here. Because treasury bills are shorter duration. We're talking about treasury bonds, which are longer duration. Their chief investment officer said, Gold is now the asset that demonstrates resilience, surpassing treasuries. High quality stocks and gold serve as the most effective hedges. This marks a break from tradition, as gold outperformed bonds as the classic diversifier for equity portfolios over the last 2 decades. Now, I want you to take a look at what Ray Dalio is saying. So if you don't know Ray Dalio, he's the founder of Bridgewater Associates, which is the largest hedge fund in the world. So Dalio is saying that investors should hold more gold than usual, and investors should allocate as much as 15% of their portfolios to gold. So did you know that investors currently, they have less than 1% of their assets allocated towards gold? Now, I want to share with you my opinion, and I imagine that there's probably going to be many financial advisors that are going to disagree with me or even hate on me, but so be it. This is just my opinion. So first of all, if you want to park your cash in short-term treasury bills because you're going to need cash in the near future, I think that's fine. Again, we're talking about short duration. But my opinion is that US Treasury bonds, which are longer term duration, if you want to invest in treasury bonds, that is a losing proposition because it's basically like a guaranteed loss. So I'm going to tell you why. If you buy a US Treasury bond, then you're going to be paid interest, right? So right now, the going rate is about 4 to 5% a year. If you buy it now, then that rate that you get, you're going to be locked in there with that rate for the next 30 years. But I just want you to know that this is well below the rate of inflation, which means that you're effectively going to be losing money. That's why I'm saying it's a losing proposition. And some people might say, Brian, what do you mean? Because according to the government reports, the rate of inflation is currently at 2.9%. And if you get a 4 to 5% return, that's your yield, that's your interest rate, then that's higher than the rate of inflation, the reported 2.9%. Okay, just so you know, if you haven't figured it out by now, the CPI inflation reports that's provided by a government is not the true rate of inflation. If you're skeptical and you don't believe me, then I want to show you this. So I dug this up from the Federal Reserve's website. If you want to see it for yourself, you can. Just go to the New York Fed's website. If you go to page 5, here's what it says. In sum, although CPI does not measure true inflation, we currently have no thoroughly viable alternatives. Okay, so this part, what I just told you, it's not my opinion. I'm just telling you what they're saying. If you didn't know, if you haven't caught on by now, the government CPI inflation reports, that inflation figure, that rate that they report, does not measure the true rate of inflation. It measures the change in the cost of the standard of living. And I'm sure that you probably can easily see or understand that, okay, if it's going to measure that, then that's very subjective and it's easily open to manipulation and deception. Basically, it gives them more ability to twist the story. The true rate of inflation, whether you want to use shadow stats or TLC or the money supply, is generally about double the rates of the government's reported CPI figure. Now, here's where my opinion comes into play. This is just the way I see it. Why would you invest in a bond and get paid 4.6% a year when the true rate of inflation is at 5.8% a year? You're losing out to inflation. That is a guaranteed loss. So what's my opinion of this 60-40 rule? I'll just say that it might have been the right move in prior decades, but not anymore. Do I agree with the 60-20-20 rule suggested by Morgan Stanley? My answer is no. I just want to say that I think that US Treasury bonds should be 0 in your portfolio, 0% allocation. If you want to go for other fixed income sources that beat US Treasury bonds, then I support that. Again, if you want to own bills, short-term Treasury bills for shorter duration holdings, probably outside of your retirement account, then I can understand that. But Treasury bonds, I would say no way, because again, it's a losing proposition. Now, here's something that I want you to think about. So this is food for thought. I'm basically going to be connecting the dots for you. More people are now understanding the reality that gold is superior to sovereign bonds. And more of these experts, institutions, and hedge funds, they're going to become more vocal about this sentiment. And if they do, what do you think is going to happen? When this goes more mainstream? You have to remember that on average, less than 1% of people's portfolios are allocated towards gold. Dalio is recommending 15%. Morgan Stanley is recommending 20%. And another example, Jeff Gundlach, like a lot of people know him, who's known as the Bond King, who's the founder of Double Line Capital, he's a billionaire, is saying 25% allocation to gold. And this guy, again, he's the king of bond trading, and he's saying go heavy on gold. All these people are starting to say this in 2025, and what do you think is going to happen? They're going to be telling their people, they're going to be telling their clients to get into gold. So I want you to think about that. The central banks have already been loading up on gold. They've been front running this. And then the next wave is going to come from smart money from the institutions. And then it's going to be followed up by the retail wave. Essentially, there's going to be more demand for gold. The price of gold has already risen substantially, but we're still in the early phase of this gold rush, which I'm going to cover more in a separate video. So I just want you to realize that the institutions, they're now going to be pumping gold to their clients. Smart money is going to be driving gold prices even higher. Gold is around $4,200 a troy ounce right now. And Bank of America says, and look what they're saying. They're saying $6,000 by spring. And here's another example. Jamie Dimon, CEO of JP Morgan, says that he sees gold hitting $5,000 to $10,000 in the foreseeable future. Essentially, what I'm trying to say is that as portfolio managers and advisors switch their recommended allocations from bonds to gold, that's going to be a new wave of demand, pushing gold prices higher. So I just wanted to bring this to your attention because I see a lot of people asking in the comments, is it too late to get into gold? Obviously, it would have been better to have gotten into gold or heavier into gold a few months ago, a few years ago, a decade ago, decades ago. But you know what? The price is just going to keep on going up. Is it going to go up in a straight line? Of course not. There's going to be ups and downs and short-term volatility. But long run, it's just going to go higher. Anyways, please subscribe. I'll keep you updated. Thank you for the support and wish you a very nice day. Take care.